Ever noticed how your favorite coffee seems to cost a little more each year? How about the price of a loaf of bread, a gallon of milk, or a tank of gas? It's not just your imagination. Yes, it's true. The cost of everyday life has been steadily on the rise for years now. Let's take a closer look at this phenomenon. Remember when you could ride the bus to work for less than $1? Now you're lucky if it's under $2. Or the time when you could fill your car's tank with gas for less than $20? These days, you might need to shell out over $50. And it's not just transportation. Consider something as simple as your morning cup of joe. A few years back, you could enjoy a decent cup of coffee for around $1. Now you're likely to pay more than double that amount. What about a loaf of bread? In the past, it was a staple that would barely make a dent in your wallet. However, in recent years, the price of bread has risen drastically. And then there's housing, rent, mortgages, property taxes, they all seem to be going up. Remember when a modest 2-bedroom apartment in a decent neighborhood didn't cost an arm and a leg? Those days seem to be long gone. The same goes for healthcare, prescription drugs, doctor's visits, hospital stays. All these costs have been climbing at an alarming rate. Even education hasn't been spared. College tuition, textbooks, school supplies, they've all become significantly more expensive. Now you might be wondering why this is happening. Well, the answer lies in a little something called inflation. In a few minutes, we will discuss ways to help you manage and take control of inflation, but let's briefly go over what inflation really is. Inflation, in simplest terms, is the rate at which the general level of prices for goods and services is rising. Now let's break down how it's measured. Two main tools are used: the Consumer Price Index, or CPI, and the Producer Price Index, PPI. Imagine a shopping basket filled with goods and services people typically buy, like food, clothing, housing, and fuel. The CPI measures the average change in prices over time that consumers pay for this basket. So, if that basket cost $100 last year and costs $105 this year, that's a 5% inflation rate. On the other hand, the PPI measures the average change over time in selling prices received by domestic producers for their output. It's a bit like the CPI, but from the producer's perspective. Now, central banks play a crucial role in managing inflation. They hold the steering wheel of the economy, using tools like interest rates to keep inflation in check. When inflation begins to rise, central banks can increase interest rates. This makes borrowing more expensive, slowing down economic activity, and in turn, reducing inflation. However, it's a delicate balance. Set the interest rates too high, and you could stall the economy. Too low, and you risk letting inflation run wild, eroding the value of money. This might sound complex, but here's why it matters. Inflation impacts everything. It influences the price of your morning coffee, the rent or mortgage you pay, even the value of your savings. If prices rise faster than your income, things can get tough. Understanding inflation is vital because it affects every single one of us, from the food we eat, to the homes we live in, and the money we save for the future. But what causes inflation? Is it just a natural part of the economic cycle, or is there more to it? Let's delve a little deeper into this question. Inflation, at its core, is a rise in prices over time, which can be driven by three primary factors. These are demand-pull inflation, cost-push inflation, and built-in inflation. Let's start with demand-pull inflation. This occurs when demand for goods and services exceeds their supply. Think of it like a bidding war at an auction. When more people want the same item, they're willing to pay more for it, driving up the price. A real-life example of this is the housing market in many cities around the world. As more people are looking to buy homes, prices have skyrocketed. Next, we have cost-push inflation. This happens when the costs of production increase, causing producers to raise their prices to maintain their profit margins. A very recent example of this is the rise in fuel prices. As the cost of oil increases, it becomes more expensive to transport goods, and these costs are often passed on to consumers in the form of higher prices. Lastly, we have built-in inflation. This is essentially the expectation of inflation. If businesses expect that their costs will rise in the future, they may increase their prices preemptively. Similarly, workers might demand higher wages in anticipation of higher living costs, which can further fuel inflation. The COVID-19 pandemic has served as a catalyst for all three forms of inflation. Lockdowns and disruptions to supply chains led to a decrease in the supply of goods, driving up prices, a clear case of demand-pull inflation. Meanwhile, businesses faced increased costs due to health and safety measures, contributing to cost-push inflation. And amidst all this, the expectation of higher prices in the future has led to built-in inflation. One factor that's often overlooked, however, is the role of corporate greed in driving up prices. Yes, you heard right. Corporate greed can and does contribute to inflation. Let's talk about grocery store chains and other consumer goods companies. These enterprises are in the business of making a profit, and there's nothing inherently wrong with that. But when profit margins keep increasing without a corresponding increase in the value or quality of the goods, we start to see the effects on our wallets. Take, for instance, the case of the German gas crisis. Russian gas supplies fell by 60%, leading to a significant economic impact. Yet instead of finding a balanced solution, the response was to increase the usage of coal in power stations, an action that could potentially lead to higher prices for consumers. Or consider the rise of the federal deficit, projected to be a staggering $2 trillion for fiscal year 2023. This increase in spending, coupled with a 19% inflation since January 2020, significantly depreciates the value of the US dollar. Once again, the common citizen stands to bear the brunt of these decisions. Even in Canada, despite impressive economic recovery from the COVID-19 crisis, structural issues like inflationary pressure, weak investment, and tepid productivity growth persist. The net debt to GDP ratio has risen from 31.2% to 42.4%, indicating a potential increase in cost of living for the average citizen. These are but a few examples of how increased profit margins and fiscal decisions at the corporate and governmental levels can lead to higher prices for consumers. In essence, the pursuit of profit, when unchecked, can contribute to inflation. But don't worry, it's not all doom and gloom. There are things you can do to protect yourself from the effects of inflation. Have you ever felt like you're getting less product for the same price? That's not just your imagination. It's a phenomenon known as shrinkflation. Shrinkflation happens when companies reduce the size or quantity of their products while keeping prices the same. It's a stealthy form of inflation that can hit your wallet hard. For instance, let's take a look at your favorite chocolate bar. Over the years, you may have noticed it getting smaller, but the price? It hasn't budged. This isn't a simple case of corporate greed, it's a strategic response to rising costs. By reducing the size of the product, companies can maintain their profit margins without raising prices and potentially losing customers. This is not just limited to the food sector, it's also common in household goods. Ever noticed how your laundry detergent runs out faster than it used to? Or how about that toilet roll that doesn't last as long? That's shrinkflation at work. The packaging may look the same, but the quantity inside has decreased. Shrinkflation is another way inflation can affect us, but just like with inflation, there are ways to protect yourself. Stay tuned to find out how in our next segment. Inflation might seem like an unstoppable force, but there are ways to fight back. First and foremost, let's talk about investing. Inflation-protected securities, or TIPS, are a type of U.S. Treasury bond designed to help investors protect their money from inflation. These bonds are indexed to inflation, so as inflation rises, so does the value of your TIPS. It's a way to ensure your investment doesn't lose value over time due to inflation. Next, let's consider the power of diversification. This is the practice of spreading your investments across a variety of assets such as stocks, bonds, and real estate to reduce risk. By diversifying your portfolio, you can protect yourself from the negative impacts of inflation on any one asset class. For instance, when inflation is high, stocks often perform well, while bonds might struggle. By having a mix of both, you're better positioned to weather the storm. But fighting inflation isn't just about investing. It's also about making smart spending decisions. Consider this: when prices are rising, it becomes even more important to spend wisely. Be conscious of where your money is going and make a concerted effort to cut back on unnecessary expenses. This can be as simple as making a budget and sticking to it. Another practical tip is to focus on increasing your income. This could mean asking for a raise at work, starting a side hustle, or investing in your education to qualify for a higher-paying job. By boosting your income, you can help offset the impact of rising prices. Lastly, don't forget the power of saving. Even in an inflationary environment, it's important to continue saving and investing your money for your future. Consider stocks, bonds, real estate, or even high-yield savings accounts or certificates of deposit that offer higher interest rates to help your money grow faster. Always do your research and talk to a financial advisor about the right strategy for you to beat inflation. Remember, knowledge is power. By understanding inflation and taking proactive steps, you can protect your financial future.